Here's a quick recap of this morning's business simulation, Jarrod's construction company. Jarrod opened his business with $1,250 of his own money, which he took to the bank and opened a checking account in the name of Jarrod's construction company, which is usually the first thing you do when you start a business. You open your own checking account. And then he went out to Home Depot and he bought all the equipment that he thought he might need for his construction company for $850. Then he got a job. He remodeled Na's bathroom and billed Na $250 for the job. Na paid the $250 sometime later, and then Jarrod took his money and paid $50 to Fairman because Fairman actually had done the work, and Jarrod paid $100 to Jennifer for rent on the building. Now we come to the accounting. The accounting equation is assets equals liabilities plus equity. And in this case, our assets are going to be cash plus an accounts receivable and equipment. We won't have any liabilities. Normally we'd have accounts payable, but we will have owner's equity. The first transaction was $1,250 in cash, and then Jarrod paid $850 for equipment, and then billed Na for $250, and that's an accounts receivable. When Na pays the accounts receivable, hold on, I'm just going to carry these balances down here for a second. When Na pays the accounts receivable, it reduces accounts receivable and increases cash. Bring the balances down. And just real quick before I do the last transaction, I now have $650 in cash, no receivables, have $850 in equipment, and no liabilities. So $650 plus $850 equals $1,500 in equity. Remember that equity is the amount that's left over after you subtract liabilities from assets. The last transaction is we paid our expenses of $150, and sure enough we have $500 left in our bank account, $850 in equipment, and our owner's equity is $1,350. To summarize this, we have cash and equipment, so we have $1,350 in assets total. We have no accounts payable, and we have $1,350 in owner's equity. So assets equals liabilities plus equity. We had $250 in revenue, $150 in expenses, so we had net income of $100. And so our original contribution of $1,250 was increased by our income to come up with ending owner's equity of $1,350.